Finance, where he managed a portfolio of over 3,500 million rupees, and at Carvey Investment Banking, leading deal origination and execution. Mr. Madhav Mehta sir has a strong track record in deal advisory, having worked with high-profile clients across sectors such as infrastructure, retail, and finance. Sir, I'm handing over the class to you. You may proceed. And this meeting is live on YouTube. Students, please take care of your mic and video. Although it is not allowed to you, but if you raise a hand to ask question, I will allow the same.
Yeah, good morning, friends. Am I audible? Yeah, am I audible? Can you hear me? Yeah. So let me share my screen and we have a short presentation. So we'll divide the presentation into two halves. The first one being the role of research analyst. What are the primary responsibilities of research analyst? How the role shifts, what are the qualities which a research analyst would require, and certain fundamentals of research. So, with your consent, I'll just share my screen. Yeah. So, first things first, keep all your mobiles on silent if you can, please. Yeah. Now, introduction to research analyst profession. So, first things first, what do we understand by the word analysis? Normally, the generic understanding of the word analysis is the act of studying or examining something in detail in order to discover or understand something more about it, or your opinion or a judgment about it. The opinion and judgment has to be after the act of studying and examining, not before it. Unlike what really happens in the markets, which I find ki most of the people have opinion or judgment on almost everything without a detailed understanding or study. So the word analysis refers to examining something in detail. Yeah, just a second. Just give me a minute first.
Sir, actually your presentation doesn't have an NISM logo and also. And actually when it goes on YouTube, no, director sees it and he doesn't like.
So what do you want me to do? While I'll just a second.
You can switch it, like if other PPTs are there, no, you can switch it somehow.
Can you just take 2 minute break and we'll just add a logo?
I'll do that.
Yeah.
I'll-
I just message them.
Sure, I'll do. Dear students, give us just 2 minutes and then we'll be back. We have some technical glitch, please allow. Yeah, Akhil, am I audible? Just give me 2 minutes. I'm putting in the chat. You may start, sir, please.
Yeah, sorry, sir. Yeah, so please switch off your mobiles. Uh, the primary role of a research analyst is to do what? Let's understand that somebody wants to buy a mobile, and what is the process when a rational or a normal person wants to buy a mobile? He goes through the specifications of a mobile, looks at the various models which are available, finds out what this is the value proposition of each and every aspect of a mobile, whether what he is buying, whether it meets his requirement, whether it does not meet his requirement. See what is the price value ratio, meaning what is the value in proportion to the price which the mobile delivers to him in terms of consumption, and he buys a mobile. Can we say that the same methodology which we use to buy a mobile or to buy a consumer goods or to buy any other item, buying a stock or buying a bond or buying an asset for investment is the same process? Well, the answer seems to be an astounding yes. But there are two facts which needs to be taken care of. First of all, the act of buying a consumption good is different from the act of buying an investment product. Investment can only happen in an asset. What do we mean by the word asset? The word asset in accounting sense means anything from which future economic benefits are likely to flow to the person who holds the asset. If you are holding an equity asset or if you are holding a bond, the future economic benefit from the bond is the coupon which the bond will deliver or the redemption premium which the bond would deliver. If it is an equity asset, then it is the future economic benefit is the dividend and the capital appreciation which it would deliver. If it is a gold, it may be saying that the future capital appreciation which gold may deliver. If it is real estate, the rental income which the real estate generates and the capital appreciation at the time of sale which the rental assets delivers, that is the income or the future economic benefit expected from that asset. Now compare that with a consumption asset. The only thing which a consumption asset delivers is the utility of using that particular asset. Therefore, there is a distinction between analyzing and examining buying of an consumption asset vis-a-vis buying the investment asset. The job of a research analyst is to advise or help make investment decisions. Yeah. The analysis criteria may be qualitative, may be quantitative. What do we mean by qualitative and quantitative? By quantitative and qualitative is means what all a research analyst would need to understand to make an assessment or advice on an investment decision. The management quality, the product profile of the company, the future prospects of the company, the future prospects of the profile of the product of the company, the service profile of the organization, the management bandwidth, the employee strength of the company, the external factors as in how the economy is performing vis-a-vis the particular industry and how the industry is performing vis-a-vis the overall other industries. So there are qualitative aspects and there are quantitative aspects to an analysis. Now the hierarchy of data less than information going towards analysis going towards wisdom, and knowledge, and knowledge going towards wisdom. Right now, our focus and the job of a research analyst somewhere straddles between analysis and knowledge, and the ideal is to go towards wisdom. So it starts with data, converting it to information into which is subject to amenable to meaningful analysis. Doing the analysis means going through the data and examining the data, and then converting that analysis into meaningful knowledge which is amenable to application. Finally, at the point of application, it is part of wisdom. Yeah. So what are the primary roles of a research analyst? Sell side research analyst, buy side research analyst, independent research analyst. Have you guys heard these terms? When we say sell side research analyst, what we mean is that research analysts which are employed by brokerages, which are employed by investment trusts, which are employed by intermediaries and parties, where they make their money by selling the products, either selling the research as is or selling the trading, or the brokerages who make money by trading. So they induce trading or they give ideas for making investments. So most of the research which we see online, which we if you Google or any research reports which are available, are sell side analyst research reports. The buy side analyst reports are basically reports or research which is done by people who are employed by private equity funds, venture capital funds, mutual funds, and funds which essentially are interested in taking or buying or trading in securities, and they evaluate whether it makes sense for them to buy or not. So buy side research is generally not freely available in the market. It is a sell side research which is generally available. Now there are independent research analysts also. For example, the CRISIL and the CARE rating agencies, they also have their own research departments, and they do give a paid access to their research. So these are independent research. There are a lot of other blogs and other independent, like there is one Mr. Hemendra Hazari who does independent research. There are various other top analysts who do independent research, and then they publish either in their blogs or they give paid access to their research reports. So these are independent research. The primary responsibility of a research analyst is to analyze what we call as the EIC framework. EIC framework is economy, industry, and company. So normally we hear it in the market, no, top-down analysis, bottoms-up analysis. So you guys have any idea as to what we are speaking about, a top-down analysis or a bottoms-up analysis? Yeah, yeah. Any pointers on top-down? You can put your views in the chat box. So, top down is basically when you start. For example, let me give you an example. Suppose you go to and visit a DMart store, and in the DMart store, you bought some 10 odd items, and you're standing in the cash queue, and you realize that there are 10 other people who are waiting in the queue ahead of you, and you look here and there for opportunities or arbitrage where koi ek queue mein, if there is a less number of people, let me sneak in there and get out faster, and you realize that there is no arbitrage. Almost all the queues have similar number of people, and even if there are less number of people ahead of you, the people have more number of items. So effectively, the time which is going to take you to do the cash counter checkout is going to be the same. So you just stay and stick to your line. And while you are standing in the queue at DMart, you realize that what a great business DMart has. I have bought something and I am waiting in a queue to pay money from them. There are 15 counters in this store, and there are 10 people at each counter. There are 350 stores which DMAT has, and at any point of time, there are almost 3,500 or 5,000 people waiting in a queue simply to check out and give them money for the stuff which they have bought. There is not a single rupee of debtor which the company owes or it has a receivable. The before a person steps out of a DMart store, he has paid the money. The goods which he gets is on credit. What a great business to be in. Let me look at the stock of the company and see whether it makes sense for me to invest in the stock of the company and make money. Now, before you get out of the DMart store or before you get into the car and go to back to your residence, you say, "Let me buy a few shares of DMart. I have some 20,000 odd rupees in my bank account, and the DMart share is around 3,500, 3,700 per share. Let me take a 7 odd shares of DMart and keep it with me and test it out." So before you even went home, based on your primary first-hand experience, you take some call, and based on your data and based on your evaluation, on your experience, you made an investment. That investment is bottoms up in for as for all you know. Now what happens is that when you get home, you go to the DMart website, you go to the listed and the available information on the company DMart, and then you also speak to a few friends who have been tracking the retail sector. Then you read about the retail sector, then you realize the retail sector in India is about 12.5 crore worth of value. Organized retail is 10 to 15% of the total overall value. Within the organized retail segment, DMart is a significant and a contributory player. And the prospects of DMart likely to grow vis-a-vis the other retail players are far higher simply because of the model which it is operating. It is straddling the affordable category. More importantly, it is having its own real estate, which means that there is a inelasticity or stickiness of the buyer to the particular store which DMart operates. and the value proposition which is being offered by DMart vis-a-vis the other players is way higher, and therefore the stock which I have bought DMart makes sense for me to hold and maybe even add at dips. So what we did is we bought top downs, but we validated the story top down. Top down. Yeah. So the top down validation happened by way of what? It happened through the EIC framework. What did we say? First, India is a blooming economy. India's GDP is 3.5 trillion, growing at 6 to 7% per annum. Retail is a major sector. 12 lakh 50,000 crores is the size of the retail sector, growing at around 7 to 8% or maybe 10%. Organized retail being 10 to 15% of the retail overall retail market, growing at double digit rates as compared to the unorganized portion, leading to a higher amount of opportunities within the organized frame of all the players. DMart seems to be standing out vis-a-vis the other players. So we started from the economy, went to the industry, and finally narrowed down to the specific company which we wanted to invest in. So the primary role of a research analyst is to validate or to use a top-down method of analysis to present and to work on or validate his investment ideas. Let me tell you, friends, most of the times the ideas are generated bottoms up, but they are validated top down. Yeah, I will be making a few comments in the chat so that the ideas stick with you even after the session. Is that fine with you? Can I have a thumbs up or something? Yeah, can you hear me? Yeah. So, messages to everybody. So, most of the investment ideas in real life are generated bottoms up but validated tops down. Yeah. When we say tops down, we mean using the EIC framework. That is, start with the economy, industry, and finally narrow down to the company level. Yeah. Basic principles of interaction. As a research analyst, not only will you be going through publicly available data, you would also be making personal communications with the management, do some pre-meeting research, have independence and neutrality of your views, network, and more network, and have clarity of questions. Now, what happens is that most of the promoters or most of the businessmen whom you come across would naturally be salesmen, right? 80 to 90% of the promoters which are there in the world today, not just in India, have got some kind of sales background some way or the other. Yeah. And they have gradually gone on to be entrepreneurs in their own way. So most promoters whom you meet will have a charisma, will be able to impress upon you. A in-person meeting with a promoter generally goes well and he would be able to sell his ideas to you. That is because he's a far better salesman than you as compared to others. Or the research analyst. You just maybe research analyst has just started in his career where he is a master in sales. How do you evaluate when you meet such people? First of all, knowing the fact that he's a better salesman than you or he's a better charismatic person than you is an important aspect, and that cures 50% of the problem. Knowing itself or awareness of the same. Second is that the evaluation of any person or any management, primary, if I have to point out one particular aspect which differentiates one management vis-a-vis another management, is walking the talk. By walking the talk means, has the management been able to perform or act in the way in which they have spoken about? So if you look at the past interactions of the management and if they have given a certain business plan, or if you look at the management commentary in the annual reports or the analyst con call meetings or generally available investor reports, and whether the management has been able to walk the talk, as we normally say, whether they have been able to deliver what they have promised, is a strong indicator as to the quality of a management and as to what, whether to take something which the management says with a pinch of salt or whether to take it at face value. So that is a strong communicator. So one of the things which needs to be remembered when there is a personal interaction or communication with the management is two parts. First, understand that he is a better salesman than you, and secondly, evaluate basis on the delivery of past promises or whether he has been able to walk the talk. Pre-meeting research. Generally, in investment banking, being part of investment banking myself, used to always have a saying that doing advanced work is the best way to actually get more work. Yeah. So what is the advanced work which a person would do when he acts as a research analyst and he goes and meets a particular prospect customer? The advanced work which he will be able to do is go through all the publicly available information on the company, go through the profiles of the promoters with whom he would be interacting with. What is the pedigree and my management pedigree which he has? What are the publicly announced future plans of the company? Most importantly, it goes without saying, check out the website and the web profiles of the companies whom they are meeting. They are competitors, they are customers, they are suppliers. Yeah. Make your own notes. Independence or neutrality of view. I have written the word avoid heuristic. Now, heuristic is actually a technical term which comes from behavior finance. We will be talking very briefly about behavior finance in the towards the end of this session before we break. But to tell you heuristic, if I have to describe heuristic in one word, it's basically mental shortcuts. What do we mean by mental shortcuts? If you go back to our DMart store example, which I just gave, where a person standing in a queue bought DMart stock simply because of his own experience, that there were so many people waiting in the queue to buy the waiting in the queue, and he analyzed that the business has excellent prospects. What did he use? He did not do a thorough research analyst work, correct? He did not went through the financials of the company, nor he did a thorough research analysis, nor he used any quantitative methods. He simply developed or deployed certain mental shortcuts. Say, okay, so many people are waiting in the queue to make the payment for the stuff which they have bought. So many number of stores. It speaks volumes about the business and the kind of business it is. And he used that as a proxy to make an investment. So that is nothing but a mental shortcut, but a mental heuristic. So now the question comes, should we use mental shortcuts or should we not use mental shortcuts? Mental shortcut has its basis in intuition. And intuition has its basis in some way or the other to some form of recognition of some past event, some past happening, some past representative data, some past occurrence, some experience. So anything which is has a recognition comes as part of intuition. So there is nothing wrong with dealing with intuition, but intuition has to be trusted in the presence of stable regularities in the system. If there are no stable regularities in the system, intuition cannot be trusted. Intuition, I'm just writing it in the chat box, can only be trusted in the presence of stable regularities in the operating environment. What do we mean by stable regularities in the operating environment? Let me give you a very stupid example if that may be the case. As kids, we were taught how to cross a road. We remember our parents used to hold our hands together, and then they used to advise us, look on the right, look on the left, are there any vehicles coming? Make sure that the road is clear before you cross. Ideally, use a zebra crossing. And we have imbibed that learning and are using it till date. Today, when we cross a road, we are just doing it as a motor skill, for all you know. Our subconscious mind is making sure that we don't bang into any vehicles and we cross the road. The reason why we are able to do that is because the operating environment is stable. गाड़ी राइट से या लेफ्ट से आता है, ऊपर नीचे से तो नहीं आता है. So the operating environment is more or less stable. Go back to the market. In a market scenario, most of the times a market is a two-way mechanism where our behavior also has an effect on the market, correct? Unlike unlike a play a game or unlike a sport where you are going with the ball and the ball doesn't react. But in the market, when you participate in the market, each sale or each buy has an effect on the market. It's the impact which is to be assessed. So when the market is a dynamic, so your own behavior has the effect of impacting the market. So in that manner, it's a two-way dynamic. And therefore, the operating environment at times tends to be unstable, in which case the using of mental shortcuts or using of heuristics is not to be done. Therefore, activate your conscious mind whenever the operating conditions are not stable. What do I mean with independence and neutrality of the view? Suppose you meet a promoter and that promoter happens to be your distant relative, or it happens to be your friend's father, or he happens to be have not this, or you are enamored by the promoter's charisma when you met him in person. You have to maintain your neutrality of you. You have to maintain that independence. Any conflict of interest has to be immediately disclosed. Conflict of interest has to be immediately discussed, not necessarily a conflict of interest, even a perceived conflict of interest necessarily needs to be disclosed. If you look at CNBC and if you read if you happen to hear the stock commentary which happens at the end of the day, or some stock analysis which happens over the weekend, most of the times the participants make clear disclosures as to whether the particular stock which they spoke about is part of their portfolio, is part of the advice which they have given to their clients or not. Fourth point, network, and more network. What do I mean by network? Network has three parts. One is networking sideways, which means knowing more and more other research analysts who are tracking similar companies, similar industries, other companies, other industries, to find out what are the pitfalls, what has been their experience, what is their view. Then there is networking sideways and there is networking downways. What is networking? Networking top. Networking top means you are networking with other promoters, business leaders, key executives of various companies whom you are tracking with, and various companies whom you aspire to track, or they are competitors. So that is networking upwards. What is networking downwards? Networking downwards is where you are able to identify with certain employees or the lower level employees of the company who have no incentive to not share information to you, not any inside information. We will come to what is inside, what is not inside information, but who have the ability to give you a grounds level or a grassroots level view as to what is happening in the company or the industry. For example, let me give you an example. I come from my last job was in Aditya Birla Finance, which happens to be an NBFC. It is one of the large NBFCs operating today. I was with them till 2017, before which I started myself. After which I started myself. Uh, so till today, I do have connects with various people working in Aditya Birla Finance and other NBFCs who are competing with them, like Tata Capital or for that matter Piramal Finance. And sometimes I do bump into them and say, "आजकल deal flow बहुत कम है. Not many transactions are coming about. Even if they are coming about transactions, they are not easily getting through the risk system, and we are not able to do effective disbursements." Yeah, so this kind of information is not inside information, but what it tells you is that based on your network, you are able to get some information which is slightly better than what is available publicly in the normal source. So networking is very important, sideways, upward, and downward. Fifth point, clarity of questions. When you interact with promoters, when you interact with key management, when you interact with veterans in the industry, the clarity of your questions and the summary of your questions needs to be had beforehand. What do we mean by clarity of questions? For example, questions should ideally be closed-ended, not open-ended. For example, let me give you open-ended questions. You're a retail sector analyst, and you go to meet the DMart promoters or the DMart CEO, and you ask him, "Sir, what is your view on retail?" That is not a question. It is an open-ended question. The answer can be open-ended. He can speak for hours on that same topic as to what is his view on retail. Most of the time, he has already given his view on retail in the management discussion and analysis section of the annual report. Have you read the analysis, research, and analysis of the management analysis and research in the annual report? If the answer is no, that means you don't have the clarity of the question. What could be a clear question? For example, in DMart, you're meeting DMart CEO, and the clear question could be, Sir, we had currently you're operating 350 stores, and the management guidance seems to be open as per the last con call and another 10 stores. Uh, which geography are you looking to add? Are you looking, you are predominantly in the west and the southern region? Are you looking to add to the northern and the eastern region, or these 10 stores will be brownfields in the western and the southern region? So this is a pointed, closed-ended question where there will be a clear factual response. Avoid open-ended questions, ask close-ended questions. What the management is prohibited from? Management is prohibited from giving future guidance or future projections or future this is. So these questions also need to be avoided. For example, sir, what is your view on what would be next year's PAT? What would be next year's EBITDA? He can't give that number to you. Don't ask that question. All he can give you is what is the guidance. What is it that we are looking to grow next year, sir? Are we looking at another 10 store expansion, 12 store expansion? What is the kind of same store growth are we looking at? Yeah. So these are the kind of questions which should normally be coming in. Uh, Ashutosh, Ashutosh, you're there.
Yes, sir.
Ashutosh, can I just send you your presentation and you can put it on our live screen, because then I can read the messages in the chat box.
Sure, sir. Sure, sir. I can do it, sir.
Yeah, I will just mail you my presentation while I keep talking.
Sure, sir.
Yeah. So just a second. I'm just closing the presentation for a very brief and before I just mail it out to you.
Can you see it, sir, on my screen?
Yeah, Ashutosh, I've just mailed it out to you.
Okay, sir.
Yeah, can you just put it on screen share? Yeah. So we were at communications guidelines. What is the, I would like to give 5 points as to how to communicate. First of all, ask close-ended questions, not open-ended questions. Second, don't ask personal questions. What is personal questions? Some management, some senior executive is suffering from some disease, and you ask him, sir, what is your health profile? Are you okay to come regularly to office? Are you not? Avoid asking personal questions because they cannot answer privately to you. So avoid asking personal questions. Second is, avoid asking questions or deals which are uh, avoid asking questions or deals which are likely to jeopardize his ability to answer questions to you. For example, there may be news in the market that one particular company is looking to acquire another company. Now that is public news, and then you ask the question to the management, sir, when you are likely to close the transaction? At what value the transaction is likely to be closed? What would be the key terms of the transactions? Those questions can't be answered at that point of time based on our SAB guidelines. So avoid asking these questions. Now, when you make your research inputs and when you do your research analysis and you are communicating to your prospects, if you are a sell side investor, to the larger audience or the larger customer set, if you are a buy side analyst, then to another, if you are a buy side research analyst, then to another, if you are a buy side research analyst, then to another fund manager or part of your organization. part of your organization. Avoid using any kind of jargons or abbreviation. Be clear in your communication. Wait, Ashutosh. Just wait. I'll ask you to change the slide. Yeah. So avoid using jargons or abbreviation. State very clearly. Explicitly state your assumptions which you make in your research report. For example, if you've done a research report on DMART and you are expecting your research report is predicated on the fact that DMART will be able to grow 20% for the next 3 years, that assumption needs to be made explicitly. If your DMART's existing EBITDA margin is 5.5, 6%, and you're projecting DMART's EBITDA margin to be 7% or 8% or 9% for that matter, that is an assumption which needs to be stated explicitly. If you are predicating, if you are assuming that DMART will be spending 350 to 400 crores of capital expenditure in the next 3 to 4 years, that assumption needs to be stated explicitly in your research reports. All research reports needs to be in a simple, clear, and a concise language. What do we mean by simple, clear, and concise? Three rules. Rule number one: use short sentences. Rule number two: use short paragraphs as well as sentences. Try using bullet points and pictures as much as possible. Making it very easy to read. Anything which helps reduce the cognitive strain of a person, it makes it more readable. For example, if you look at any poster or any large research report which you come across, they will be using bright colors, combination of royal blue and red, not pale green or pale yellow. Good color contrast. Font size is large enough for the other person to easily read, not very small font. Not very packed paper in terms of not a very packed research reports where the large paragraphs and big sentences. No, avoid that. So these are things to avoid. Any conflict of interest needs to be explicitly disclosed a priori. Yeah, we can go on to the next slide. Yeah. So quality of a research analyst. If you can see the picture which I have put in there, it will be quite clear. Numeric ability or an ability to deal with numbers is a primary requirement for anybody to take up a profession of a research analyst. Without the use of numbers or without a mathematical ability to compute numbers, it obviously numbers doesn't mean advanced statistical techniques or advanced arithmetic, advanced algebra or advanced geometry. What I mean by numbers is basic arithmetic and basic spreadsheet skills. An ability to handle large volumes of data, have conceptual clarity, financial concepts clarity, financial statement analysis, ability to ask pertinent questions, which we've already discussed, attention to detail, and a good communication skill. Now, if you look at the qualities which are required of a research analyst, automatically one tends to think that accountants would be good research analysts. Yeah, all accountants would be a good research analyst. Correct. So anybody who has an accounting background and who is good with basic numbers, who has a good understanding of financial statements, really have an advantage as compared to others who don't have an accounting background? Yeah. My answer to the question, being an accountant myself, is a categorical no. The reason why I say it is a categorically no is that, first of all, it is not all that difficult to understand financial statements even for non accountants. Let me just give you or clarify or give you a shortcut as to how to understand financial statements from a non accounting perspective or non accountants. So, as accountants, we all understand assets, liabilities, and assets should equal to liabilities. For my friends who are engineers or who belong to the science profession or who belongs to the non-account stream, can you not view the balance sheet as a set of equations where the primary equation is capital is equal to assets minus liability, and then every other equation is a subset of that equation? So let's say total assets is equal to current assets plus current liability. Current asset is equal to stock plus inventory plus other current assets. Liability is equal to borrowed fund plus current liabilities. Current liability is equal to trade payables plus other current liabilities plus provisions. So the entire balance sheet can be converted into a set of equations. And if you start viewing the balance sheet as a set of equations, with the primary equation being capital is equal to assets minus liabilities and assets is equal to liabilities, then in that manner you can decipher the financial statements in a far meaningful manner. Let me tell you, as research analysts, your job is to interpret financial statements, not to make financial statements. So your ability to review and have a view on financial statement is what matters, not the ability to prepare a financial statements. What is the other advantage with a non-accountant has? He may be able to bring perspectives to the table which an accountant may not be able to. 100% of the value of any company or any stock lies in the future. Yeah. We will have a second session tomorrow on fundamental analysis and risk analysis. We will dwell on this question more deeper tomorrow. But if you have to apply any kind of valuation methodology and value any stock, the valuation is a combination of numbers and a story, which is nothing but a multiple, or a discounted cash flow, which is nothing but a discounting of future cash flows. So there is no number which is used in a valuation exercise which pertains to the past, but almost every number which pertains only to the future. Therefore, anybody who has an ability to understand the future and map the future better vis-a-vis others has an advantage in being a research analyst or a valuation analyst for that matter, not necessarily a person from an accounting background. So all the non-accountants who are part of this session, be be happy that it is not a disadvantage to be non-accountant or not have an accounting background. In fact, you may be free of certain prejudices. Let me be straight with you. Yeah. So please use the heuristic which I have just given. Try to convert the balance sheet into a set of equations. And once you convert the balance sheet into a set of equations, you will find that life and understanding is way simpler as compared to the terms which are used in the balance sheet. Yeah. So let me give you another example. So what is PAT or profit after tax? How do you get to profit after tax? Profit after tax, if I have to write it as an equation, is sales minus direct minus material cost gives gross margin, minus direct cost gives contribution margin, minus administration overheads minus selling overheads gives to the EBITDA, minus depreciation minus interest comes to the profit before tax. From profit before tax you minus tax is equals to PAT. All this can be put it as an equation. Yeah, put it as an equation and see life becomes simpler. The next slide, we can go to the next slide. So terminology which is used in equity and debt markets. Equity analysis, just stay on this slide, Ashutosh, for some time. What do we understand by the word equity? What do we understand by the word equity? Equity means what? What is the right? So equity is an asset. We just discussed the concept of an asset in the first half an hour of the presentation. And equity means, what does it give rights to? It gives two rights. Rights to dividends, which the company declares in the future, and right to capital appreciation as and when you make a sale of your particular holding. So equity is an asset, but the use of the word equity is why it is the word equity is used. The use of the word equity is because there is no difference between the rights of one shareholder and another shareholder. Yeah. The rights of shareholders qua the company which has issued the equity is the same, proportionate to their holding. For example, if the company declares a 10% dividend and I hold one share and somebody else holds 10 shares, then each of us will be entitled to the same 10% dividend on that share. Obviously, my dividend will be proportionate to my holding, which is one share, and his dividend will be proportionate to holding, which is 10 shares. But it will be 10% only. A company cannot differentiate between two equity shareholders, which is why the term used is equity. Yeah, equity, not preferred, not any other word, but equity. So there is a parity between any two shareholders, between the company and the shareholders. That is equity. Now, equity, is it permanent capital or temporary capital? From the company's perspective, equity is a permanent capital. Unless there is a reduction in the capital which is mandated by a high court, which is unlikely to be the case, never the case in India. Equity capital is part of permanent capital. The fact that the equity shares of the company are traded on a stock exchange, and I, as an investor, can liquidate my holding by selling it on the stock exchange to somebody else, does not make it temporary capital. It is permanent capital from the company's perspective. The only thing is that it is tradable if it is listed. Is equity a security within the meaning of Securities Contract Regulation Act? Answer is yes. Equity is a security within the meaning of the Securities Contract Regulation Act, and therefore the all the provisions of the Securities Contract Regulation Act as applied to any other security which is part of Exchequer is applicable to this. We have a brief 15-20 minutes tomorrow on the legal and regulatory framework, which we will cover this more in detail. We can go to the next slide. So equity is basically the right to the residual cash flows of the company. So what is the residual cash flows of the company? If I have to answer it in one word, it is PAT, profit after tax. Means after every other stakeholder in the company has had his share of rights in the company, if I have a senior debt holder and I have a right to redemption, I have a right to coupon after my coupon, after operating expenses, after depreciation, that is after providing for reinvestment, after taxation, whatever remains, whatever is the residuary, that is what belongs to the equity shareholder. And therefore, in common parlance, an equity share is a right to the residual cash flows of the company. Yeah, equity is the right to the residual cash flows of the company. From an equity perspective, we normally come across terminology like face value, book value, market capitalization, enterprise value, replacement value, and finally intrinsic value. What is face value? If I am a company and I have come up with an IPO and I issue 1 lakh shares at the rate of rupees 50 per share, the face value is 10 rupees and the premium is 40 rupees. So 50 minus 10, face value is the premium. Face value is the nominal price of a share. A company may issue shares at face value, it may issue shares at a premium, or it may issue shares at a discount. So, premium and discount is with reference to the face value of a share. So, if you open any balance sheet and go to the shareholding schedule of the balance sheet or the notes to the balance sheet, you will find the face value mentioned there. If you go to the ROC website or the Register of Companies website, the face value of each company's equity share will be given. The face value can be increased, can it be reduced? Answer is yes. By a share split or a stock split, it can be reduced. So there are a lot of companies which are traded in the markets where the face value at the time of inception was 10 rupees per share. It has been reduced to 5 rupees per share or 2 rupees per share or 1 rupee per share. But it has to be an integer. Face value has to be an integer. integer. Discount and premium on share issuance is with reference to face value. Yeah. What is book value? Book value is basically a difference between assets and liabilities. What is the difference between assets and outside liabilities? Capital. So capital plus free reserves plus other statutory reserves is the same as assets minus liabilities. Go back to the same equations. So what is the principal equation which I said? Capital equals assets minus liabilities. That is the principal equation, and every other equation flows out of this. As an equity analyst, your primary job as an equity analyst is to see as to what is the growth rate of this capital, means at what rate the company is increasing its value. That is the primary job of an equity analyst. So essential analysis of equity is capital is equal to assets minus liabilities. Is it market value? Is it book value? In India, we have something known in accounting as a historical cost convention. By historical cost convention is meant that all assets and all liabilities are recorded in the books at the price at which they are acquired, which means that what the balance sheet values of assets and liabilities are the acquisition costs of those assets and liabilities, that is the historical cost, which is the book value and not the necessarily the market value. For example, I may have acquired land to build put up a factory 20 years back. 20 years back, I would have acquired the land at 5 lakh rupees. That land is not restated in the balance sheet, and therefore therefore the value at which the balance sheet carries that land is 5 lakh rupees, whereas the actual market value of that land may be much higher. Now, we may come across a thing, why should it not be recast at a higher value? First of all, there is a provision for recast in the audited financial statements where companies do choose to recast they revalue their assets to reflect the current value. But most importantly, for a business asset, there is only a value in use. There is no value for sale. For example, if I am a going concern, that is, I am running a factory and I am operating a plant. Till the time I operate the plant and my business is running, I am not going to sell the land, correct? I am not going to sell the machinery. So the market value of the underlying land and the market value of the machinery technically has no meaning because it is only a value in use. There is no value for sale. The asset is held for use. The asset is not held for sale. And therefore, the balance sheets in India and even for that matter abroad use the historical cost convention, which is reference to the book value. So book value is the accounting value or the historical cost value. What is the market value or the market capitalization? Market capitalization is nothing but the total value of the company as per the traded market price. So market capitalization is number of shares equals number of shares multiplied by current market price per share. Yeah. So if I have to say what is the market cap of DMart, we can just look up at DMart. No, we can just add and look up DMart market capitalization. Yeah. So what is the market cap of DMart? Any answers? Yeah. It is 2.3 lakh crores roughly. The market cap of DMart currently is 2.3 lakh crores, which is nothing but the last traded price of DMart multiplied by the number of shares of DMart. That is the market price. What is the enterprise value? The enterprise value is market cap, or we call the EV is equal to market cap plus net debt. This can be further expanded. So net debt is nothing but total debt minus cash bank balance. Yeah. Why is the word EV or the enterprise value very important to valuations or to understanding of equities? Because EV is a representative of the operating capital of the company, meaning the market cap plus the net debt. So EV for a manufacturing concern where there is a portion is debt, or for example a mining concern or a power generating concern, a EV ratio or a EV by EBITDA ratio is a very normal used denominator for arriving at valuations. And therefore, EV is a very important term when understanding equities. So enterprise value is the value of the enterprise irrespective of the manner of capitalization. What it means is, so capitalization can be either by way of equity or it can be either by way of debt. So enterprise is a combination of capitalization, which is equity and debt. So equity referring to the market capitalization and debt referring to the net debt, gross debt minus available cash. Replacement value. The term replacement value is a term which was very prevalent during Harshad Mehta's time. Harshad Mehta was 95, there was a 1995, there was a Harshad Mehta scam, and he was one person who popularized the replacement cost theory. Not that replacement value was not known earlier, but it was a term which was popularized by him. What do we mean by replacement value? Let me give you an example. I have set up a manufacturing plant 20 years back. Now, after 20 years, I have been operating for 20 years. I have had customers, I have had vendors, I have a regular stream of orders from various customers. Because of that, there is a goodwill which is available to me in the market. Means based on my name, new orders are coming. Based on my organizational pedigree, new orders are coming. Yeah. When that is happening, new orders are coming. When that is happening, what is for us somebody who wants to start afresh and compete with me? What will he have to do? He will have to reinvest in a plant and spend so many years operating and creating that goodwill or creating that market reference for others to trust him before people do business with him, correct? That is a replacement cost. Means if somebody were to do something on its own, how much cost and time it would take for somebody else to come up to a level as to where the company is today. That is replacement value. Now, coming to intrinsic value last, we will be discussing intrinsic value at length tomorrow in our discussion on valuation principles. But what do we understand by intrinsic value? There are two terms which are normally used in valuations. One is a price and one is a value. The difference between the value and the price is what we are assessing. As research analysts, our primary job as equity research analysts, our primary job is to find out the difference between price and value. Price is what we pay and value is what we get, is a normal word which is used by large investors like Warren Buffett. Yeah, value means if something is priced today at less than the intrinsic value or less than the value, it makes for a buy call. If something is priced today at more than the intrinsic value or more than the price, it makes for a sell call. How do we arrive at value? That is part of fundamental analysis and that is part of the valuation exercise which we will do, which we will understand tomorrow. So intrinsic value is basically the underlying value of a particular security or a particular equity share vis-a-vis the quoted price. So for example, DMart today is quoted at some 3,900 rupees. Yeah, 3,580 rupees. If I believe that the intrinsic value of the share of DMart is more than 3,589 rupees, that means it is a stock in which I should have a buy position. If I believe the value is significantly lower vis-a-vis the current traded price, then there is a difference between the price and the value, and therefore the stock may be overvalued to that extent. So valuation call, price is a given number, value is a derived number, value differs from person to person, and since it differs from person to person, that is the primary reason why trading happens on the stock exchange. If you look at every trade which happens on the stock exchange, both the parties to the transaction feel that they have got the better of the transaction. The buyer feels that he knows something about the company or the stock, whereby the value is higher than the current market price, which is why he buys the stock. The seller feels that he knows something about the company or the stock, whereby the price at which the share is being quoted is lower than the value at which the share is according to him, and therefore he is a seller. And therefore, each participant to the market transaction, there is a difference in value, which is why the trade happens per se. Yeah, let's go to the next slide. Some ratios with respect to equity, earnings per share, dividend per share, price earning, price to book, price to sales. Earnings per share is nothing but the total earnings which are available to equity shareholders. What is the earnings which is available to equity shareholders? PAT. Earnings available to equity shareholders is PAT, which is profit after tax, which is nothing but residual earnings. Yeah, total earnings divided by the number of shares which are outstanding comes to a EPS number or the earnings per share. Dividend per share is the amount of dividend which the company has declared per share divided by the total number of shares, that is the dividend per share. Normally, in most cases, where the company is paying out a portion of its earning, the dividend per share is a subset of the earnings per share. DPS is normally a subset of EPS. Yeah. What is the price earning multiple? As the word says, price. Price is the price per share, earnings is the earnings per share. So price earning multiple is price per share, the quoted price per share divided by the earnings per share is the PE multiple or the price earning ratio. What does it indicate? Price earning ratio indicates the number of times earnings the market is willing to pay for the share of the company. So PE indicates the number of times of earnings which the market is willing to pay for the stock of the or the share of the company. Yeah, it is predominantly used. Can anybody tell me what is the price earning multiple of the BSE Sensex today as we speak? So my price earning multiple maybe for a particular stock, maybe for a particular Sensex or an index. So let's ask two questions. What is the price earning multiple of DMART, which we are discussing today, or we are using as a base example? And what is the price earning multiple of Sensex? Yeah. So DMART price earning multiple is how much? Any guesses? It is roughly 86 times its earnings. And what is the price earning multiple of the stock exchange stock or the BSE Sensex? Yeah. Any guesses? You can put it in the chat box. It is roughly around 21 times as we speak today. 21 times Sensex earnings. Yeah. What is the price to book value? We just referred to the concept of book value in the previous slide. Book value is basically the historical cost of assets minus liabilities. So price to book value is nothing but the market price per share divided by the book value per share. That is the price to book value in ratio terms. What does it indicate? Where is it used? In certain businesses, the book value is predominantly reflecting of the market value. For example, banks. Most of the banks' assets are in the form of monetary assets or liquid assets. These assets are denominated in monetary terms only, they are not physical assets. When the assets are denominated in monetary terms, the book value is a very good representative of the current market value. In which case, the book value tends to, not same as, but tends to market value, where the ratio of price to book value becomes a very meaningful number. Last, price to sales. What do we refer by price to sales? It is nothing but the ratio of the price per share divided by the sales per share or the market capitalization divided by turnover over or sales is the price to sales ratio. Where is the price to sales ratio used? Normally, why would somebody compare the price with the sales which the company is making? It should ideally be compared with the earnings, correct? The equity is a right to the residual earnings of the company. Since the equity is a right to the residual earnings of the company, the valuation which should be compared with the earning ability of the company. But in a lot of companies, in a lot of sectors, especially in sectors which are at a nascent level or at a high growth level, there are negative earnings or there is a long gestation period of projects, in which case the sales is used as a proxy to gauge the valuation of the company or give or to get an indicative of where the company stands today. For example, companies like Zomato, Paytm, or for that matter Even insurance companies, price to sales ratios has been used predominantly to make comparisons. What does the price to sales ratio indicate? It indicates that there is a certain waterfall. Means given the level of sales, this is the kind of profitability which is likely to happen. It definitely indicates some kind of a waterfall. And therefore, in certain areas, certain companies where it is not possible to correctly compare earnings, sales are compared. Yeah. Let's go to the next slide. Very important slides. You come across this term regularly. Regularly, we come across these terms DVRs, differential voting rights. We've understood what is an equity share. Now, what is a DVR? We defined an equity share, and the word equity is used primarily because there is no difference between the rights of one equity shareholder and the other equity shareholder. Every equity shareholder has a proportionate voting right in the company affairs. What is a differential voting right? Differential voting right is a set of equity, which is a set of shares which have been issued by the company, where the voting rights vis-a-vis the normal equity shares is different. Means it carries less amount of voting rights. So there may be a lot of retail investors or institutional investors, or for that matter, government agencies or participants of the market who may not be interested in being a active voting rights in the company. The company may be large enough, it may be well governed, and they may not want to participate in the voting of the company, and they may say, okay, we are more interested in the dividends and the capital appreciation and less interested in having voting rights. In which case, companies do carve out a portion of their capital requirement in the form of differential voting right shares, which is called DVRs. It is nothing but a normal share, except that it carries less than one voting right per share. Yeah. Number of voting rights for a DVR may differ from company to company based on the kind of DVR they expect. Examples of companies which have come up with differential voting right shares are, classic example is Tata Motors. Tata Motors DVR is actively traded in the stock exchange. And again, conflict of interest. I am a shareholder of Tata Motors DVR, so I must categorically acknowledge it. Maybe at the time when it was issued. Yeah. But these are Tata Motors and future. Are we continuing?
Yes, sir. I think we lost you. One sec.
Where did I lose? Because where at what point can you just put it in the chat box? I need to repeat a few portions. At what point, Ashutosh? Can you hear me? Hello.
Yes, sir. Few seconds only. I think you were telling about it varies from company to company, and from
Yeah.
there, yeah.
Can you just put up the presentation? Can we have the presentation, Ashutosh? Yes. Can you put it on slideshow? Hello. Yeah. Just- Yeah. So, friends, is that correct? That can you just put a thumbs up in the chat box? We were at the differential voting rights would differ from company to company. That is where we were at last. Yeah. Okay. So typically they trade as a separate category or an instrument and are available at a discount to common shares. Why will the differential voting rights be available as a discount to common shares? They will be available at a discount to common shares simply because the voting rights are lower as compared to a normal equity share, correct? So if the rights attached to a particular share is lower as compared to a different category of shares, which is a normal equity shares, certainly it would be available at a discount to the common shares, correct? Yeah, so that is the reason. Now the Companies Act 2013 gives a detailed list of requirements for companies which can issue DVRs or differential voting rights shares. But the primary or the key requirement of the Companies Act, which I have just listed for reference, is the company should be dividend paying. At least 10% dividend should be paid by the company in the last 3 years. The shares shall not exceed, means the DVR should not exceed 25% of the post issue paid up capital of the company. For example, if my current shares number of shares are 100, I cannot issue more than 33.33 shares as DVRs, because 33.33 divided by 133.33, that is 25%, correct? So 25% of the post issue paid up capital should not be, more than that should not be DVRs. Dividend, last 3 years minimum 10% dividend year on year, and 25% of the post issue capital should not be in DVRs. That is a primary requirement for eligibility to issue DVRs. This instrument, when it was first popularized by Tata Motors and Pantaloons for that matter, did not acquire much popularity in India. This is a very popular instrument internationally, but in India it has not acquired so much prominence. Although the Tata Motors DVR issue has been a very successful DVR issue. So, yeah, let's go to the next slide. Can we go to the next slide, Ashutosh? Yeah. So we've just covered the basic terminology of the equity market. Let us just very briefly touch upon the terminologies of the debt market. Ashutosh, can we just cover this 4 5 slides on the debt market and then break around 11:45? Is that fine? Or do we need to break early? Hello? Yeah, Ashutosh, can we just cover these slides or do we need to break early?
You can take break early, sir, if you want, sir.
No, I would like to cover next 15, 3, 4 slides on the debt markets before we break, if that is
Sure,
okay.
sir. Sure, sir. Please,
Can you
please.
just put out the presentation so that there is chronology of the thought process?
Sure, sir.
Yeah, yeah. Please put on the presentation. Yeah. So features of a debt market. So when we deal with debt, there are 4 terms primarily which we understand when we deal with debt. Next slide, Ashutosh. Principal, coupon. Next slide, Ashutosh. Principal, coupon, maturity, and collateral security. What is a principal? A debt is, what is the principal? If I have acquired 100 rupees of debt, if I have borrowed 100 rupees of bank loan, then 100 rupees is the principal. What is the principal borrowing which I have done? What is the coupon, the rate of interest which I am going to pay on the loan? If I have taken a home loan of 25 years, 20 lakh rupees, 20 lakh rupees is the principal. 25 years is the tenor of the loan or the debt, or the maturity profile is over a period of 25 years. And the coupon is the applicable rate of interest on that particular loan, which is currently, let's say, 9%. What is the collateral security? The underlying house, by use of the funds basis which I have acquired the house, is given as a collateral security. So that is a collateral security. What is the principal feature of a debt? Fixed obligations. The one word answer to debt is fixed obligations. What is equity? Residual cash flows, means variable. Residual means सब हो जाने के बाद, whatever remains. So it is always in a state of flux. But with respect to debt, what is important in debt? Fixed obligations. My coupon is fixed, which means the amount which I have to pay as interest is fixed, and my principal repayment, which means my redemption, is also fixed. So fixed obligation is equal to debt. Residual cash flows or variability is equal to equity. Put it very simply. Yeah. Commonly used terms in debt: holding period return. What is the holding period return? If I have invested in a debt security, let's say if I have invested in a particular bond of a particular stock on the bond market, or for that matter, I have purchased a bank fixed deposit. That is also a debt only from the bank perspective. It's a deposit, but it's a debt from the bank perspective. Correct. So the entire return which I get in the entire holding period, which is, what is the return which I will get through the holding period? First is I will get regular coupons, and at maturity I will get my principal back, or at times there may be a redemption premium at maturity. So if I add together my coupons and the premium which I am to get at redemption at a later point of time, all the incomes divided by the principal or the price which I have paid for acquisition of that particular bond, that is the holding period return. Holding period return is not an annualized return. It is the return or the absolute number for the entire holding period. It is not an annualized number. Holding period, I am writing it in the chat box. Sorry, I holding holding period return is not an annualized number. It is an absolute number for the holding period. Yeah. What is the current yield? Current yield is nothing but like a earnings per share or a dividend per share. We just understood the concept of earning per share and dividend per share with respect to equity. So current yield is nothing but dividend per share. Let's say what is the earning from a particular bond or a particular debt interest coupon. So let's say if I have acquired a bank in FD and my rate of interest is 7%. If I have acquired a bank FD and my rate of interest is 7%, then I have acquired 1%, then my current yield is 7 divided by 100. So that is 7% is my current yield. Now, what happens if I have acquired a bond which is traded? My coupon is 7%, but the bond price is fluctuating on a daily basis based on the price at which the market is doing. So in which case, what happens is that the bond price has gone up to, let's say, 110 rupees. So my earnings yield is 7 divided by 110. What is that number? 7 divided by 110. So it is 6.36%. So earnings yield is the current coupon of the bond divided by the current market price of that particular bond or the debt instrument. An important concept in bond understanding of bonds is YTM, which is called yield to maturity. YTM, that is yield to maturity. We have a separate slide on that. Ashutosh, can you go to the next slide? Yeah. It is a comprehensive and a widely used measure. What is the YTM? The rate which equates the present outflow from the bond with the present value of future inflows. Example, I have purchased a particular bond at 100 rupees. I am enjoying a coupon of 7%. I will have it's a 5-year bond, redemption it at the end of 5 years. So for the next 5 years, I will have a coupon of 7%. So year one is 7, year two is 7, year three is 7, year four is 7, and year 5 is 7. This is the coupon of the bond. The value today is much higher as compared to the value 1 year later. Means these are the future cash flows. If I have to discount these cash flows to their present value, then the total of all these cash flow currently comes to 35. Total future cash flows is 35. But discounted value would be less than 35. Yeah. If I take the discounted value to be less than 35 and compare that with the price of the bond today, means the price at which it is trading today, then the implicit value, that is the YTM. Yeah. So it is nothing different than the concept of an IRR or the internal rate of return which we learn in corporate finance. The rate which equates the present outflow from the bond with the present value of future inflows. That is YTM. It is also called the IRR of the bond. We can actually use an Excel IRR function, and we can understand what is the what is the yield to maturity. Ashutosh, if you allow me to share my screen, I can open an Excel sheet and we can do a ITM calculation right across. Yeah, if I can I just share my screen, open an Excel sheet and share my screen. Yeah.
Please, sir.
So let's say the investment amount in bond, or the face value of the bond, is 1 lakh rupees. Yeah. Current price is 1 lakh 5,000. The coupons is 7%. Tenor is 5 years. Yeah. So what are the dates of the coupons? Let's say, so it is 31 3 2026. Let's say, let me just put a date format so that it's easier. It's much easier. Yeah. I just drag it down, make this 27, make this 28, 29, sorry, 29 and 30. Yeah. So what is the coupon? Coupon is this face value into this. Yeah. Let me just put a, yeah, drag it down. These are the coupons. Let's say we are sitting at 31st March. This is, let's say we are sitting at, for the sake of simplicity, let's say we are today, which is price is at, this is 25. We're sitting at this. Okay. This is today's date for the sake of simplicity. Yeah. Right. What is the redemption? So redemption is no redemption here, no redemption here, nothing, no redemption here, no redemption here, and here the redemption is 1 lakh rupees, correct? Which is nothing but the face value which will be redeemed. Yeah. So what are the future cash flows? Future cash flows is this plus this. This is the future cash flows. Yeah. Now I put this date. If I buy this bond today at 1 lakh investment, yeah, then I buy it as 1 lakh 5,000 rupees. So this is my investment. So the cash flows of the bond are this. Yeah. If I takes an X IRR of this, then I will get the YTM. So what is X IRR as a function? I am taking an X IRR. So X IRR. Yeah. What are the values? These are the values. What are the dates? These are the dates. Yeah. I close this and I do this. 5.82% is the YTM of the bond, or the yield to maturity. Is this clear to all, or do I need to come again? You can put your comments in the chat box. This is a very important concept and I don't mind repeating the concept if required. Yes, please. Any participants? Can you please repeat it? I have received from Akhil Raj Tripathi. Akhil, I'll just go through the spreadsheet. The face value of the bond is 1 lakh rupees. Today is, let's say, 31st March 2025, and you want to acquire this bond. And the market price at which the bond is trading today is 1 lakh 5,000 rupees. So your acquisition cost is 1 lakh 5,000 rupees. When you acquire this bond at 1 lakh 5,000, that is why it is shown as negative 1 lakh 5,000, because that is the money which you will be parting today. Based on your you parting 1 lakh 5,000 today, the cash flows from that bond, first cash flows will be 31st March 2026, 7,000 rupees, which is the coupon, 7% into 1 lakh rupees, which is the face value of the bond, that is the coupon. Next year 7,000, next year 7,000, next year 7,000, last year also 7,000, and you will be getting your principal back. So 1 lakh 7,000. So this is the profile of your cash flows. Year one minus 1 lakh 5,000, then 7777, and then 1 lakh 7,000. So what I have done is I have done an IR or a date weighted IRR calculation of these cash flows. So 5.82% is the implicit yield in the bond. What is the assumption now? Now is that now clear? XIRR is the date weightage internal rate of return. X, I'm writing it in the chat. XIRR is the date weighted adjusted internal rate of return. Yeah, it is an Excel function which can be used very conveniently to calculate YTM. All we need is the cash flow profile and the dates alongside. Yeah. If you want, I will be happy to put this spreadsheet in the chat box. Do you want me to put this in the chat box for you to check the formula? Can I put this in the chat box? Yeah, how do I attach in the chat box? Just a
Sir,
second.
there is one
Yeah, yeah, I got it.
document link there.
Yeah, yeah, got it.
Host and panelist, one document link is there. Documents sign, you can
Yeah,
just.
is that come? I have posted. Yeah,
Yes, sir, I got it.
yeah,
Others?
yeah. So you cannot understand any debt product or any debt without understanding the concept of YTM, which is yield to maturity. What is the implicit yield in the bond? For example, if you have bought a particular bond at 100 rupees face value at 7% coupon, but it is trading at 105 rupees, which means that the price or the implicit yield in the bond is lower than the coupon. Yeah, Ashutosh, you can now start the presentation. Just go
Sure,
to
sir.
the slide. Uh, Guys, please bear with me. We have another 4 slides before we break, so that we have the continuity of the thought process. Yeah. So what are the assumptions which are there in a YTM? When we do a YTM calculate, the first assumption which we are assuming in bond is that the investor is going to hold the bond till maturity, which is what the name says, yield to maturity. Means you are calculating the yield of the bond, assuming that you are holding the bond till maturity, and you are realizing the face value of the bond on redemption. Second is the implicit assumption when you do the XIR function or calculate the yield to maturity is that the coupons, the 7,000 rupees coupon in the examples which we just had, are reinvested at the same rate as the bond. means the 7% is reinvested at 7%, which again implies implicitly that the interest rate remains same across tenors. Yeah, which is a static yield curve or a flat yield curve. So two implicit assumptions of YTM. Now, despite these assumptions, YTM is a very powerful indicator and it is predominantly used for almost all bond pricings. Yeah, it is a single matrix which is used to compare bond yields. Very important measure, despite the assumptions. Then we can go to the next slide, which we have a concept of duration. Can you just go to the next slide? Duration measures the sensitivity of the price of the bond to change in interest rates. Now, a question to all the participants on the call right now: what is the relationship between a bond and the interest rate, a bond price and interest rate? As the interest rate goes higher, bond prices increases or bond price falls? As interest rates go higher, do bond price increase or do bond price fall? You can put your answer in the chat box. Very important fundamental understanding for any participant. Yes. As the interest rate increases, bond price falls. Durga, your answer is correct. Anil, your answer is wrong. As the interest rate increases, bond price falls because the coupon is fixed. When the coupon is fixed and the market interest rate increases, means in the market expectation of that bond or the yield of that bond has to increase to meet the market. Therefore, the bond price has to fall in order to compensate for the increase in interest rate. Am I able to communicate or do I need to come again? Yeah. Do I need to come again on this? Let's go back to the same example which we had where I gave you the YTM example. And if you open that same Excel sheet and instead of 1,05,000 in the sheet, you make the price to be 1,10,000. There is an increase in interest rates, and therefore the bond price has to reduce. So you will have to reduce from 1,05,000 to 95,000 or 90,000. So Ashutosh, can you again allow me to share my screen? Yeah. Yeah. So we had this example. Yeah. So now, if the interest rates in the market, overall interest rates in the market, let me tell you, the coupon 7% will remain fixed throughout the tenor of the bond. If the interest rate is increasing, which means that for per unit of investment in the debt, people are asking for a higher rate of interest. Therefore, the bond price has to fall. So let's say the YTM is 5.82% in this example, but the market expects a 7% YTM, or let's say, for example, 8% YTM, which means that this 1,05,000 rupees has to fall. Yeah. So what should be the revised number? Let's say 85,000, or let's say 90,000. Yeah, iteratively, let's do it. Yeah. So somewhere 97,000, 98,000, 99,000, 97,500, 96,000. Yeah. So if the revised return or the interest rate expectation in the market increases to, let's say, 8%, then the bond price has to fall to 96,000 so that the YTM equals this interest rate. So whenever there is an increase in the interest rates, the bond price will tend to fall. When there is a reduction in the interest rates in the market, the bond price will tend to increase. Is this concept clear to everybody? Yeah. Is this concept clear to everybody? Can I have a thumbs up on the chat box? Or do I need to come again on this concept? Yeah. Thank you. Ashutosh, we can again go to the slide share and I'll stop sharing my screen and we just cover last two slides before we break. So duration is an advanced concept as compared to yield to maturity. What duration measures is the sensitivity of the price of the bond to change in interest rate. We just saw in the example of the YTM sheet, as when the interest rate increases or the expectation of interest rate increases, to match the yield to the current interest rate, the price of the bond has to fall. The sensitivity of a particular bond to changes in interest rate, that sensitivity is defined as duration. It is the weighted average maturity of the bond. The present value of future cash flows are used as a weight to derive this duration. Higher the maturity of the time to maturity, higher the duration. Whenever there is a fixed income instrument, debt is a fixed income instrument, correct? We define debt as a fixed income instrument. It is also called as fixed income instruments. So the biggest risk in the fixed income instrument is what? Answer is time. The higher the tenor of the instrument, the greater the risk, because it is fixed in nature. So whether the company will be able to meet its fixed obligation or not over a long duration of time is the risk. So higher the tenor of a bond, higher the risk. Higher the risk, higher the rate of interest. Therefore, you find when you go to bank deposits or when you buy any loan, if the duration of the deposit is higher, the rate of interest offered is generally higher. Generally, not always, but generally. Sometimes what happens is that banks have some asset liability mismatch and they want money for 1 year tenor or 2 year tenor, and to incentivize that, they may offer a slightly higher rate of interest. But as a concept, higher the tenor of a particular instrument of a fixed income in nature, higher the rate of interest. So the sensitivity of the price of the bond to changes in the interest rate is what we refer to as duration. Can we go to the next slide? Yeah, Ashutosh, next slide. Types of bonds. Various bonds are types of where zero coupon bonds. What are zero coupon bonds? Zero coupon bonds are nothing but where the coupon rate is zero. So why will somebody invest if the coupon rate is zero? The answer to the question, people will invest if the coupon rate is zero because these bonds are issued at a discount. For example, the bond face value at 100 rupees, it will be issued at 70 rupees, means you invest 70 rupees. At the end of 3 years, 5 years, 7 years, 10 years, whenever that bond will come up for redemption, the entire 100 rupees will be redeemed, which means that the entire earning from the bond or the entire compensation for the risk of the bond is back ended. Your investment is discounted. You invest 70 rupees, you get 100 rupees, not as coupons, but entirely as part of redemption. That is zero coupon bonds. Example of zero coupon bonds, IDBI Bank, IDBI had issued a lot of zero coupon bonds. They were called deep discount bonds also. Zero coupon bonds are also referred to as deep discount bonds. Yeah. Floating rate bonds. Floating rate, all your home loans today, floating rate home loan interest are floating rates. They are floating rate loans. So if you have bonds which are listed where the bonds pricing or the interest rate is linked or the coupon is linked to a particular benchmark, let's say repo rate or for that matter bank's marginal lending rate, then these rates are floating rate rates. It is also possible that in floating rate loans cap and floor is defined, means the interest rate will not go beyond a particular level and it will not fall beyond a particular level. Within that band the interest rates will operate, which is a cap and a floor. Yeah. Convertible bonds. Inverse floaters will come to it later. Right now, let's first convert the others. Convertible bonds. Convertible bonds were popularized by a company in India, essentially by Reliance Industries. It was a brainchild of Mr. Dhirubhai Ambani, by which these bonds came into being in India. It is not that these bonds were new to the world; they were happening across the world, especially in the United States. But they were new to India and brought into India by Dhirubhai Ambani. To that, the credit for that convertible bond goes to Dhirubhai Ambani. So convertible bonds are bonds where the bonds have a particular coupon. They have features of both equity and debt. And at the end of a particular period or a defined event, there is an option or a compulsion to convert the bond at a pre-agreed value or at a pre-agreed formula into equity shares. Yeah. Normally, the rate of interest on a convertible bond is lower as compared to a normal bond, primarily because there is an option for it to convert it to equity, which means that whenever there is an optionality, the chance of making a higher return by converting it to equity that chance or that optionality is priced into the bond, and therefore the yield or the coupon of a convertible bond is generally lower than a normal bond. Yeah. Principal protected notes. A lot of investment entities come up with investment instruments where they guarantee principal. Where what do we mean by the guarantee principal? The product, no product or no investment as such has an implicit guarantee. But what do these investment funds do is that they say, okay, we invest 100 rupees with us. The 100 rupees, the primary principal, we will be investing in debt instruments which are fixed in nature, and therefore, to that extent, we will try and protect your principal, and the returns will be invested in equity or linked futures, which are riskier in nature, where principal protection cannot be offered. So, that is principal protected note from an investment perspective. From a company perspective or from an overall perspective, there is nothing called as a principal protect in the investment industry. So even a debt market mutual fund, if you have to see its advertisement, it will continue to say investments are are subject to market risk. Please read the offer document carefully. So principal protect is from a selling perspective, which investment companies come up with. Inflation protected securities, inflation protected securities are certain securities which are issued, bonds are which are issued to protect the principal value, erosion in principal value by way of inflation. They are pegged to a particular benchmark inflation, for example, a wholesale price inflation or a retail price inflation for that matter. And then the coupons are reset, or the premiums or the redemption or the face value of the bond is reset, or the redemption premium or the redemption discount is reset to compensate for the inflation adjustment. That is an inflation adjusted bond or an inflation protected security. Foreign currency bonds are nothing but regular bonds which are issued by a company other than its own currency. For example, companies which are operating in India, listed in India, they issue dollar denominated bonds or euro denominated bonds. These are foreign currency bonds. They carry an element of foreign exchange risk at the time of redemption and principal repayment, and therefore these bonds also have a hedging cost. To the extent of hedging cost, these bonds are generally issued because the rates for borrowing in dollars and euros may be cheaper as compared to rates for borrowing in rupees. But obviously there is a hedging cost element to it, and to that extent portion of the hedging cost eliminates the arbitrage, so to say. Now external bonds, or as we call in India, the masala bonds. External bonds or the masala bonds are nothing but bonds which are issued by players abroad in Indian currency. Means you issue a bond in the United States which is rupee denominated, which means that the exchange rate risk shifts from the issuer to the investor. In a foreign currency bond, the exchange rate risk is with the issuer of the bond. In a masala bond, the exchange rate risk is the investor of the bond. When the shift in foreign exchange risk is from the issuer to the investor, it is a masala bond. It is called as a masala bond. Masala bond is an external bond. Yeah. Last slide before we break. Ashutosh, if you can please. Perpetual bonds. Lot of banks in the last few years have come up with perpetual bonds. These bonds are primarily issued by banks, or for that matter certain corporates. Even Tata Steel has got a perpetual bond issue. Let me tell you. These are issued by banks essentially to shore up their tier 1 capital. Tier 1 capital is a capital which is mandated by as per the Basel norms by arbitrage. So perpetual bonds, what is the difference between a perpetual bond and a normal bond? First difference, it is perpetual. The name itself says it's perpetual, which means there is no fixed maturity date. But what is fixed? But it is part of fixed income, correct? All bonds are part of fixed income. So what is fixed? The coupon is fixed. The redemption or the maturity date is not fixed. Second, it is subordinated to all other deposits, loans of the banks or other bonds, which means that it is last in the order of priority. Second is coupon can only be paid from distributable profits. If there are no distributable profits, then coupon cannot be paid. Coupon is non-cumulative. Non-cumulative means that you do a FD now, and then you select the option cumulative. I don't want monthly interest, quarterly interest, yearly interest. I am okay to compound that interest and get the interest cumulatively. In a perpetual bond, cumulative interest is not allowed. It has to be non-cumulative. Why cumulative interest is not allowed in a perpetual bond? Simple. The fixed maturity date is not fixed. And if the maturity date is not fixed, it cannot be cumulated. So in perpetual bond has to have a payment interest payment frequency monthly, quarterly, half yearly, yearly. Depends on what is the choice. Beyond a year, it is not allowed. So perpetual bond will never be able to have a cumulative option. Third and the most important, perpetual bonds as per the terms of issuance can be mandated to be converted to equity on the happening of specified contingent event. For example, if a SBI issues a perpetual bond and the capital of the bank goes beyond a particular level because of there being mass NPAs in the bank, then in terms of the prospectus for the perpetual bonds, that event may be a trigger event for conversion of those perpetual bonds into regular equity shares. So perpetual bonds to some extent are quasi equity in nature. Yeah, with no fixed maturity dates. But the fact that they are tradable also makes it liquid to that extent. Yeah. So with this, the concept of terminology in bonds and equity market is over. We have three more areas to cover: fundamentals of research and equity and industry analysis, which we will carry on post break. Ashutosh, 10 minutes or 15 minutes?
Sir, 10 minutes we can give, sir.
10 minutes. So it's 11:58. So I would say by 12:10
12,
maximum.
10, 12, 10. Yeah, yeah.
Yeah. Thank you. Thank you. Thank you. Friends, shall we start? Shall we start?
Please start.
Okay, just put up the presentation. Yeah, where we stopped. Some basic fundamentals of research. We'll just spend 10 minutes on some fundamentals before we start on to industry analysis and economy analysis. Next slide. Next slide. What is the difference between investing and trading versus trading or speculation? The difference is very simple, very subtle. In a trading, a trader attempts to profit based on a spread between selling price and buying price. Even an investor makes an investment to profit from the difference between a buying price and a selling price. But a trader mainly takes a position based on volatility or fluctuation in the buying or the selling price without a change in the underlying value of the asset. For example, day trade. If I am doing day trading, I buy in the morning, sell in the evening. In one day, what is the meaningful change in the intrinsic value of the company is going to happen? Nothing. The time is too short for any meaningful change to happen. So that trade primarily predicated on profiting from volatility or changes in the buying and the selling price is trading or is speculation for that matter. Whereas investing by definition refers to betting on or predicating the increase in the investment returns from the change in the underlying asset. For example, the business becomes more valuable today, 5 years down the line, than it is today. So the change in the market capitalization of the company or the change in the underlying value of the company, that is what differentiates the investment and a trading. Yeah, next. Active investing versus passive investing. What do we understand by these words active and passive? Normally, whenever there is a choice involved, selection involved, whenever if you are selecting a particular set of securities to invest, that is active. If you are not selecting a particular set of invest securities to select, but you are following a particular index or a particular standard algorithm, that is passive investing. Active selection is active. Passively following something, some set index or something is a passive indexing investing. The objective of active investing is to beat a particular benchmark or to beat a broader asset class. For example, actively managed mutual funds, the target is to beat a particular benchmark. Passively managed mutual funds or index funds for that matter, also known as active management, passive management also refers to as indexed investing, is basically to mimic the return of the index. So that is the difference between active and passive. And if you ask me personally from a behavior finance perspective or from a psychological perspective, my answer to the question is what is active and what is passive is passive refers to your behavior while you are investing and active refers to your behavior while you are investing. Yeah. So when we say that passive investing is successful, what it refers to as behavior aspect of behavior also. Passive means you have to be less active or least active for that matter. Yeah. Next slide. Insider information. Next slide, Ashutosh, please. Yeah. Insider information versus mosaic analysis. Insider information and trading based on insider information is prohibited by SEBI and stock exchanges. What is it that is inside information? Non-public material. Three words. Non-public means it is not in the public domain. Material, not trivial matter, material matter, and it is price sensitive in nature. Material, I'm writing it in the chat box for you all. So, inside information info is combination of material plus non-public plus price sensitive. This is inside info. So, for example, if you happen to know a particular CEO because he happens to be your friend's dad, and he passes on the information to you that the company is on the verge of closing a particular acquisition transaction which may add significant value to the company, but that information is not available in the public domain, that is inside information. But if you generally happen, for example, if I was part of Aditya Birla Finance earlier in 2017 when I resigned, and I do keep meeting friends from Aditya Birla Finance, and they generally chat about me as to what is the work culture, what is the kind of deal flow which is happening in the company. Is there more work? Is there less work? Is there stress in terms of the human resource or the work life balance? That is also cumulatively giving a lot of information. Independently may not be giving information. But for example, if out I interact with some 40, 50 people and all of them confirm that there is a high level of business performance which is happening in the company, and there is a high level of businesses, more number of sanctions are happening, indicating that the business is being conducted efficiently or there is an incline in the available business, then in that case, a cumulative put together of other informations gathered from various sources, which is trivial in nature individually, but cumulatively not so. At the same time, it is not inside or price sensitive in that manner. That kind of analysis is what is called as mosaic analysis. And analyst, research analysts who concentrate on mosaic analysis or who are good at mosaic analysis generally are do extremely well in their careers. One of the reasons why we mentioned network is to basically build your ability to do more mosaic analysis. Yeah. So let's get on to the next slide. Types of analysis. Three broad methods of analysis: technical analysis, fundamental analysis, and behavior aspects. Behavior finance is not a particular branch of analysis per se, but it is generally used intermingly with the other two portions. Even technical analysis and fundamental analysis are not one to the exclusion of the other. They are used complementarily also. So why technical analysis? Technical analysis, I am going to type a lot of stuff in the chat box on these portions so that it sticks with you. Technical analysis is predicated on a primary assumption. There are three primary assumptions of technical analysis. The first assumption is that market price discounts all available information, which means that the current market price captures all the available information. Second is price moves in trends. Yeah. And finally, the third assumption is history repeats itself. Uh, yeah, these are the primary assumptions. I put some stuff in the chat box. You can share it with all, Ashutosh. I think I can only send it to host and panelists. So, primary assumptions. Yeah, can you please relate the messages? Technical analysis. So, technical analysis, people who practice technical analysis are also called chartists. Why? Because they look at charts and they look at resistance levels, support levels, various other terms. Because the primary assumption is that all the available information in the market about that particular stock or about that particular market or about that particular industry is already discounted in the price. Which means that by analyzing information, there is likely to be no other gain. Therefore, what do? You try and impute that on the stock price and you analyze the chart or the chart so that you can understand mass psychology, and basis mass psychology you are assuming that price will move in trend and history repeats itself, which is why the support level and the resistance level comes. So let me give you a brief understanding of what a resistance level is just as a prototype. We don't have much time. So suppose there is a chart and we say that the current price trading is 300 rupees and there is resistance at 250 rupees. What does that resistance means? The chart, the price volume chart is telling you that at 250 rupees, a large number of people has bought that particular stock. A large amount of trading has happened on that particular stock at 250 rupees. So unlikely that if it comes to 250, below 250, people will realize those losses, because primarily all individuals are loss averse. So people will not realize those losses, and because they will not realize, or there will be resistance from them to realize those losses, or they will not give up those gains, there will be resistance at the 250 level. Yeah. So that is the concept of resistance. Similarly, on the reverse side, the concept of support. Come to fundamental analysis. The primary assumption of fundamental analysis. Ashutosh, can you relay my messages from the chat box to everybody? Hello.
Yes, sir.
Yeah. Thanks. Yeah, if you can please, because that is the way it will stick to them. Otherwise, because this web call will just go on, they can carry something. You can go back to the screen, the presentation, please. Yeah. So fundamental analysis, like technical analysis, primary assumption of fundamental analysis is finally assumption of fundamental analysis is performance.
You can click the host and panelist and send everyone, sir. Then it will go to everyone.
It is not, no, there is no option which is giving to me. I can only
Just
see
two. Beside the two, na, you click the host and panelist, sir. It will show the options everyone where you are typing the message.
yeah, it is not showing the option, Ashutosh.
Okay, okay, sir. No
I can
problem.
share the screen just a second if you want.
Oh, no problem, sir. I'll send. Just do.
Just a second so that it's clear in case I'm missing something. See, can you see my screen?
It is
Yeah,
not there, sir. I can see.
it's not there. Yeah, yeah. So I'm stop sharing. You can put up the presentation. Primary assumption of fundamental analysis is performance drives wealth. Behavior finance is basically understanding human behavior and the effect of psychology on finance. So, profiting from greed, excess greed, and fear is part of behavior finance. If I have to put it in one word, profiting or gaining from excess human greed and or fear is basis of behavior finance. Yeah. Ashutosh, can you put up the second presentation now? Hello? Hello?
Yes, sir. Yes.
Yeah, please. Can you put up the second presentation? Yeah. Ashutosh, later on you can share the presentations with the participants. That's not a problem. Yeah. So get on to the first slide. Next. Next. Yeah. Economic analysis. So we just discussed in the first half the difference between top down and bottoms up. When we do a tops down, the first is the economy. The government of India is the largest external environment which any company or any business in this country has. And therefore understanding the economic headwinds and the tailwinds is primary to our all analysis or integral to any analysis. We don't have enough time to do a thorough. There can be an entire course on economic analysis and there can be an entire course on industry analysis, but we need to cover this in the next half an hour, 45 minutes. So with that in perspective, the first and the primary understanding when we do an economic analysis for anybody and everybody is to understand that the government does not have its own money. It does not. Even if it prints its own money, it has an inflationary effect. So when we normally hear as deficit financing, where there is any shortfall in the government revenues and the government prints money, that excess printing is increasing the money supply in the country. It is reducing the value of the existing money, which means it's inflationary in nature. So there is no free lunch, and there is government has not its own money. So whatever money the government is having and it is spending, it is pertaining to the taxpayers, and therefore there is no free lunch. That is a primary understanding in economic analysis which needs to be had to anybody. For example, if there is a large fiscal deficit or a large revenue deficit, or the government is engaging in excess deficit financing, as an research analyst, it is implicit to understand that it is going to have an inflationary effect. There is no action without corresponding reaction. Yeah. Next slide. Certain common understandings or common terms, rationality, categories paribus. All economic theories are predicated on the fact that human beings are rational. Yeah, but if you look at each of us, we will understand that we are nowhere near rational. Everybody has its own biases. या किसी को किसी चीज से डर लगता है, किसी को किसी से. For example, most of the parents in India, you would have faced that, when you went to buy a two-wheeler, you would have faced resistance from your parents. The fact of the matter is that 78% of the vehicles which are sold in the country are two-wheelers. In numbers terms, not in value terms. Most two-wheelers are, people ride in a radius of 5 to 10 kilometers of their home. Most two-wheelers are also rode in a city or in a tier 2 city or a tier 1 city or a tier 2 city where the traffic intensity and the automatically imposes a certain level of speed restrictions. Therefore, while there may be accidents in two wheelers, the number of fatal accidents in two wheelers is way less as a category as compared to vehicles which are plying on the highway. But what we are given to understand is that two wheelers are risky primarily because मेरे हमारे पेरेंट्स कभी यंग थे, कहीं कोई एक्सीडेंट देखा उन्होंने, कभी कोई पर्सनल एक्सपीरियंस हुआ, एंड दैट बायस और दैट फियर केम इनटू देयर माइंड. It is not backed by statistics, it is not backed by data. There can be many such biases. Everybody is prone to biases. Even I will have my own biases. Yeah. So let me give you and share with you my own bias, just to as a matter of sharing without any shame. I lost my father much earlier when I was 3, and I had a hard time making my ends meet. And by the time I went to the equity market, somewhere I did not understand and appreciate investing in luxury goods and luxury products. Because of that bias, I missed quite a few opportunities. It took me a while and it took me a lot of reading and understanding to understand that this was my bias. So, everyone, each of us is prone to bias. But the economic theory assumes that human beings are rational. The reason why it so assumed is because irrationality has infinite dimensions and it is not possible to model irrationality. So, therefore, I will again chat a message in the chat box. So, individually, we are irrational, but cumulatively rational. Yeah. So micro level irrationality at each individual level, but macro level on an aggregate level at a market level rationality. Yeah. Then categories paribus, other things remaining constant. We need not discuss this. Most of you understand. It is only when we keep other things constant that we understand the meaning of categories paribus, or what is the effect of one variable on the other fact. The reality of life is that एक बटन दबाने से बहुत सारे बटन दब जाते हैं, correct? And that is what we call as a cascading effect. Yeah. So when we do economic analysis, we need to understand that these 2 3 assumptions of economics which we are normally taught has to be understood in that light. फॉर एग्जाम्पल कैटरिस पैरिबस, फेड ने रेट इंक्रीज किया इसलिए मार्केट गिर गया. दिस इज अ पोस्ट फैक्टो एक्सप्लेनेशन, रेट्रोफिटिंग ऑफ एक्सप्लेनेशन. Yeah, while the markets have only two ways to go, either goes up or it goes down, but there are infinite ways in which that going up or going down can be explained. Yeah, there are infinite ways. Everybody has an explanation at the end of the market session कि market नीचे क्यों गया था, market ऊपर क्यों गया था, as if they knew everything in advance. Most of the times I find it is retrofitting of explanation, because other things being the same are never the same. Everything is dependent on something else, and the equation is complex. Therefore, other things remaining the same never really happens. Let's go to the next slide. We don't have much time. Some brief macro numbers. From an economic perspective, two, three important numbers are there. Debt to GDP ratio, market cap to GDP ratio. So I have given a few profiles. Indian GDP is currently 3.5 trillion. In terms of the world share of India's GDP, India contributes around 3.5 to 4% of world GDP. US contributes around 25 to 30% of world GDP. The market cap to GDP ratio in India 2 months back was 147%, which was 50% higher than the 10-year average. That number alone indicated to some extent that there was some level of overvaluation in the markets of the country. In the last 2 months, the correction which we have saw, the market cap to GDP ratio has come down for 147 to 120% as we speak today. The US market cap to GDP ratio is currently around 207%, and typically that range has been around 125 to 176%. The debt to GDP ratio in India is 82%, in the US it is 123%. The forex reserves, which were at near zero levels in back in 1991 when economic liberalization was taken up by the PV Narasimha Rao government, is today around 700 billion. The fiscal deficit 4.9%. If you add the states together, it adds up to as high as 10%, which is a matter of concern. Yeah, very brief few macro numbers about the country. Now I will try and give you a few my own understandings on the economy and what to look forward to and what not to look forward to before we get on to industry. So can we go to the next slide, Ashutosh? The share of GDP in India of manufacturing sector today is around 14 to 15%. Service is around 58 to 60%, and the remainder is agriculture. The share of people who are deployed in various sectors, almost 44 to 45% of the country is deployed in agriculture, which is delivering not more than 14 to 15% of the GDP of the country. Yeah. Manufacturing employs around 20%, which is delivering around 14 to 15% of the GDP of the country. And the remainder is in the service sector. So you see the drift. There is no economic miracle in the world, whether it is a Southeast Asian nations, Japan, Korea, or even for that matter, Thailand or South Africa for that matter, on the African front, which is ahead of India in terms of economic matrices, which has taken the leap, skipping the manufacturing cycle. One of the reasons why the government is promoting heavily the Make in India campaign is because the miracle or the economic miracles have not happened unless manufacturing sector has contributed. There has never been a case where an economy has gone directly from agriculture to services, skipping the manufacturing cycle. India is showing signs where it is trying to skip the manufacturing cycle, and that is a matter of concern for the government and for the analysts. One of the reasons again why Make in India is being promoted so heavy. Second, 200-year-old history of commodity prices is that on an inflation adjusted basis, the average price of commodities has remained unchanged. For example, if you take any steel or any aluminum or for that matter any commodity, and if you adjust it for inflation over the last 200 years, the price has remained the same, which means that there is no value growth in commodities, but it is only inflation adjusted growth. Third learning, most nations have gained from opening trade, whereas opening to global capital flows has produced mixed results. For example, foreign portfolio investment or FII investment in our equity markets is a opening up of global capital flows. But direct investment by foreign funds into Indian companies by way of venture capital, private equity, or FDI as we call it, is opening up of global capital flows. More we export, the more we import is opening up of global capital flows. Whenever there is opening up, Ashutosh will answer your question. Ramandeep ji, Ashutosh will answer your question. Whenever there is an opening up of global capital flows, industry has gained more. Can we go back to the presentation, Ashutosh? Yeah. In a 5 year economic cycle, the competitive landscape can change completely. Let me give you an example. 5 years back, there was BSNL who was a strong contender in the telecom industry. Currently, we have a BSNL which is practically defunct, and the telecom industry is in a space where it is almost a duopoly between Airtel and Reliance, where cumulatively they hold more than 55 to 60% of the market share. If you add Vodafone, it comes to 80%, which makes it effectively a duopoly for all that matters. So, in a 5 year economic cycle, the entire competitive landscape of that country can change. A classic example is the recent fall of Bangladesh. Bangladesh was predominantly a country which betted heavily on textiles. The reason why they chose textiles was it was a very sound reason they chose textiles. Textiles at the last end, at the processing level, when you go from weaving to fabrics to garmenting to processing, requires a lot of water. Bangladesh as a geography is part of the Indo-Gangetic and the Indo-Brahmaputra basin. So they have a lot of fresh water resources which are available for textile processing. So as a resource, water is abundantly available for textile processing in Bangladesh. Second reason, textile is also very labor intensive. So for a population which is as dense as Bangladesh, it provided the opportunity to employ a large number of people, gainfully employed a large number of people. Water was available, it could employ a large number of people. The skill intensity which is required for textile operations is much less. So it requires a lot of semi-skilled and unskilled labor also. So it doesn't necessarily require a skilled labor. Therefore, the lower rung of the population which was unemployed could be catered to by using that textile sector. So the government of Bangladesh focused heavily on textiles. And for all the right reasons, they were leaders in textiles. What happened in the last few 5 years? There was internal turmoil in the country. There was a coup in the country, because of which the supply chains were disrupted, and the customers of Bangladesh textiles started looking at other countries to de-risk themselves from the textile framework of Bangladesh. So, in a 5 years, the entire competitive landscape of a country can change. Yeah. Money dries up, trade receipts. What happened to Bangladesh? New orders went slow. New orders were not happening. Money dried up, trade went down, and so the entire economic growth went down. Bangladesh is a case in point on this particular aspect. Yeah. Next slide. Next slide. We yeah no not the before one before. Yeah. Difference between FDI FPI we just discussed. Are there any good investment binges? A lot of times we are made to understand that investment binges are not good. The answer to the question is there are good investment binges. There are a lot of good investment binges. What are good investment binges? Investment binges which are in the infrastructure sector. For example, government spending massively on new infrastructure creation, which is going to act as a support for the existing industries which are operating or for new industries which will be set up. Investment binges in the infrastructure sector, very good. Investment which is in the property sector, extremely bad for all economies. That has been the world over the experience. Yeah. Consumer price inflation and consequences. It has been the history of all elections in India and globally. I am repeating, it has been the history in India and globally that lower inflation or very low food inflation may not win an election, but High food inflation has been a sure short recipe for political loss or election loss. World over, I'm putting it in the world over, high food inflation is a sure short recipe for a political changeover or turmoil. So while low food prices may not win an election, but high food prices will surely help make sure that the government loses the election. That is a learning world over. What is financial deepening? We you use a lot of words, no? Jandan accounts, government opened 60 crore Jandan accounts. So many more people have been made participant to the banking. And we frequently in the newspaper come up with the terms of financial deepening, financial inclusion. What is financial deepening and financial inclusion all about? Financial deepening and financial inclusion is all about providing access to formal institutional credit to large and large number of people. So again, I am typing it in the chat box for Ashutosh to relate to the group. Financial deepening, financial inclusion is all about providing access to formal institutional credit to unbanked population. Yeah, you can relate. Go back to the presentation, please. Yeah, precursor to all crises and the most powerful indicator. World over, it has been recorded. Again, it is not something. It is not with a certain level of confidence, but it is basically historical experience and analysis of the world economy and the cycles of the world economy. Generally, increase in private unsecured credit, large increase in private unsecured credit is a strong precursor to a eventual market correction. Again, I am typing it in the chat box. Large increase percentage terms consistently year on year in private unsecured credit is a strong precursor to a market fall. Yeah, let's go back to the presentation. Yeah, overpricing common sense calls. What do I mean by that? What I mean by that is that if a foreigner or a person from a developed country comes to India and he finds that the local cafe is costly or expensive, or the restaurant or the hotel where he is staying up is expensive vis-a-vis his own country, that means that that country is to some extent overpriced. It is a very strong and a powerful indicator which has been used. Yeah, can we go back to the presentation, Ashutosh? Yeah, Ashutosh, I am not able to see the presentation.
Oh, yes, sir, lost you. Yeah.
Can you hear me? Can you just put up the presentation? Yeah. Next slide. General views on spotting credit bubbles. One last thing. History has shown that if there are consistently 5 years, 5 continuous years of credit growth at twice the GDP growth rate, For example, if the GDP growth rate in India is around 6 to 7%, and there is consistently 5 years of credit growth of 15 to 20%, generally it is an indicator of a pending or a bubbling credit bubble. That has been the historical experience in India and world over. So these are certain parameters which I am just sharing based on experience and understanding of the economies for reference, because whatever time was available, I just wanted to highlight a few points. We can go to the next slide. Some rules for experience: watch the locals. If the locals in the country are not investing in their own country and they are investing abroad predominantly, that means that economy is having some kind of structural problems or structural issues. Family run businesses are great until the family starts fighting. World over, that has been the experience. So India has a lot of family run businesses. Even Germany, a developed country, has a lot of family run businesses. Even Japan, a developed country, has a lot of family run businesses. The experience internationally is that family run businesses do wonderfully well for the country and for the families themselves until the family starts having feuds and they start fighting. Yeah. Second last point, be alert to the moment rulers outlive their usefulness. What it means that some kind of change of power or change of leadership after a few years is a positive rather than a negative. So countries where there has been no change of leadership, or states where there has been no change of leadership. For example, the CPI government in West Bengal continued for 25 years. The share of Calcutta as percentage of India's GDP at the time of independence was as high as 20 to 25%. The share of Calcutta as a percentage of India's GDP as we speak today is less than 5%. It has gone down. So, some change in the leadership of the state or the country, or leaders do not overstay, is a positive. We have seen this cycle happen with Libya, where Gaddafi used to rule. We've seen this cycle with Iraq, where Saddam Hussein was dominant. We've seen this cycle, currently seeing this cycle with Turkey, where Erdogan is primarily turning to be a dictator for all practical purposes. We are also seeing this similar situation in Russia. Yeah. Last, once a financial offer collapses, when it is likely to arise again? The answer to that question, it is likely to arise again when the memories of the earlier collapse fades. And when do the memories of the earlier collapse fade? When the newer participants get added predominantly. So when the next set of people come and take the market, so there are a lot of participants in the market today who have not seen the collapse of 2007-8, or who have not seen the collapse of dot-com bubble of 2000 or the Harshad Mehta scam of 95. When the number of participants who have not seen these collapses in the market rise beyond a particular level in excess of 50%, the next financial collapse is likely to happen. That is what history has taught us. Next slide. Sectoral understanding. How do we define a sector is very important to understanding of a sector. Let me give you an example of a company called PVR, or we can even say a Inox or a Cinepolis. So if you were to analyze the industry of PVR, we can very narrowly define the PVR's industry as a film exhibition business, correct? A company which primarily shows cases or exhibits films. But that would be a very restrictive definition of PVR. What a PVR does is that it is competing with the all the OTT platforms. A Netflix, a Amazon Prime, or a Hotstar is a competitor to PVR. It is giving an out of home entertainment experience. To that extent, a PVR is also competing with the Imagica also. So, if you have to define PVR as an industry, I would define PVR as an industry which is catering to the out of home entertainment industry, not a film exhibition industry. So let us have the mental liquidity to define industries the way we would understand industries. So defining an industry is very important. Impact of cyclical, potential size, secular trends, competitive intensity. What is cyclicity? We always normally hear the word no कि ये इंडस्ट्री साइक्लिकल है, ये इंडस्ट्री साइक्लिकल नहीं है. What do we mean by cycles? And why do cycles happen? One line answer, I am again putting it in the chat box for it to be relayed. Ashutosh, you can do it as your convenience. Cyclicity happens primarily because of supply not being able to adjust real time with demand. What does that mean? There are certain industries, for example, let me give you an example of a steel industry. A steel industry requires a large amount of capex for a unit to be set up. It also requires a long gestation period of 3 to 5 years before the industry starts commercial production. So today we are in a scenario, let's say, where the steel demand is very high because of a large number of infrastructure projects which the government has taken up. And what happens is that because the supply cannot overnight meet the increased demand, the price tends to increase because there is a limited amount of supply available and demand is spiking up. So the price increases to meet the available demand. Because of that, the profit margins of the existing players expand. Because the profit margins of the existing players expand, it attracts newer players in the industry. It also attracts more investments from existing players in the industry. When there is a more investment by existing players in the industry or newer players join the bandwagon, they invest heavily in the sector because there is an opportunity to make abnormal profits. With the heavy investment, this supply tends to bunch up at the end of 3 years, 5 years, whereas the demand is growing stably in line with GDP or in line with normal demand trends. The demand is not having a spike overnight, but the supply is having an overnight spike because that is the nature of the industry that supply will only happen in a lumping manner. Supply cannot happen in a staggered manner. Supply can only happen in a lumpy manner. For example, steel industry, hotel industry, real estate industry, supply will happen in a lumpy manner, whereas demand is growing progressively. So what happens? There is a expansion in profits. New players come in the industry. They invest heavily. Then supply happens at the end of 3 to 5 years, and there is a supply overhang, which means there is a excess supply as compared to demand. Price comes down, profit margins comes down. Some of the players are no longer viable. They close down the units. Some of the players go bankrupt. Again, what happens? Supply shrinks because some of the players have gone out of the market. Then slowly demand starts to spike up, again leading to artificially abnormal profits, attracting new players making new investment leading to bulking up of supply, again excess supply and demand. This is how the cycle operates. So that is how the cyclicity in any industry operates. Am I clear in my explanation of cyclicity? Because that is critical to any industry understanding. I would like a thumbs up or a thumbs down. If I need to repeat, I don't mind repeating, spending the next 5 minutes repeating this concept. Because this concept will be critical to understanding of any industry. Yes, please. Yeah. Let's go forward. So, what are the key drivers to the industry? That has to be understood very clearly. And what is the value migration in the industry? By value migration, can we go to the next slide, Ashutosh? We'll come back to this slide later. Concept, let's go forward. Yeah. Value migration in any industry, it's a term which was coined by a guy called American guy. He published a book also. There is a book on value migration, but the concept is not new. Even before the book and before his coining the concept of value migration has been there since at least for the last 20 years since I have been active. What value migration means that in any industry or in any cross section of the industry or any country, value migration may happen. Initially, there may be a value inflow, limited competition, high growth, high profitability. Then competitive stability, stable market share, stable margins, and competitive intensity. declining sales and lower profiting. So we have seen value migrations. Now, if you have to intuitively give you an example, a classic example of value migration, if you look at any sector in the country and which has there has been privatization in that sector. For example, there has been privatization in banking industry, there has been privatization in the insurance industry, there has been privatization in the telecom industry. Wherever in the country there has been privatization, we have seen that sector efficiency to have drastically increased over a period of time, and the share of the public sector units come down drastically and private sector gaining at the cost of public sector. So there has been value migration which has happened from the public sector to the private sector across the spectrum in the Indian market. Likewise, there has been value migration within the sector. For example, if you look at telecom, we have migrated telecom from the fixed telephony to the mobile telephony, within the mobile telephony from the cellular network to the data networks. Yeah. Can we go to the next slide? So I have identified 6 themes of value migration which have happened. First is technology driven micro value migration. Let me give you an example in each of them. Technology driven value migration, value migrating from the retail banking side to the UPI side. So people were using cash earlier. They were not using much of banking because they had to log on to a bank account, add a particular person as a beneficiary, then make a net banking payment. UPI has eliminated by a single stroke of technology that entire hassle. Today we have so many people by which are connected by way of UPI. So the entire payments which were happening to a banking, the lower level payments which are happening to the banking system has been taken over by UPI. Technology is a classical example where value has migrated out of the banking payment system to a UPI system. Lower switching cost, mobile number portability. Yeah, single classic example of lower switching cost. Yeah, it has ensured that the tariff remain in check. Another example of lower switching cost. Can you give me an example of lower switching cost? Anybody? You can put it in the chat box. Lower switching cost. Yeah. FMCG to some extent, the lower end of the FMCG. A lot of retailers have introduced their own brands, own private labels with similar or lower quality but lower price. Because, for example, if case of floor cleaners, in case of toiletries, if there is a price difference, people are willing to switch. People are willing to downgrade. Lower switching cost. Instead of one bucket, you pick up the next. Instead of one toothpaste, you pick up the private label. Instead of one washing powder, you pick up the lower price washing powder. Retailers have explored this by introducing their own private labels. Easier access to funding. Classical example: all two wheelers. 90% of the two wheelers in this country are funded in some way or the other, either by banks, NBFCs, or private finance. So the entire growth in the two-wheeler industry has been benefited by the easier access to funding. Earlier, most each of the large two-wheeler companies, whether it was Bajaj, whether it was Hero, or whether it was TVS, they had set up their own NBFCs primarily to boost funding for people to acquire two-wheelers. Why? Because in India, two-wheelers were bought for enhancement of productivity rather than just merely consumption or for leisure, and therefore providing easier to access to funding helps the productive potential of the person, and therefore two-wheeler funding availability of two-wheeler funding has significantly boosted that industry. Innovation, we have seen biosimilars, we have seen bulk drugs, we have seen the entire biotechnological industry which is predicated on innovation. The Paytms and the Zomatos are part of the innovation. The Uber and the Ola is part of innovation. Today, we are sitting in a scenario where the world's largest fleet running company, which is Uber, and India's second largest fleet running company, which is Ola, they don't own any vehicles. The world largest accommodation providing company, which is Airbnb, does not own a single room, does not own a single property. but it is the world's largest accommodation providing company, which is Airbnb. Innovation. They have changed the matrix. The value has migrated from the local small budget hotels to the Airbnb. Value has migrated from the locals banking small account holders to the Paytms and the UPI holders. The local restaurant business has been significantly boosted because of the ability of Zomato and Swiggy to be to be able to give their services so that they can cater to a larger geography on the food delivery business. Convenience. Again, same example, UPI is also applicable to convenience. And the biggest example of convenience is online trading. So many people have been part of stock market simply because of the convenience of online trading. I remember the days when we had to go to a broker and give the instructions in physical format or make a call for us to execute a trade. Today it is not the case. Online trading is a classic example of convenience. I have a few examples in the next couple of slides, which we can skip, we can circulate later because we have paucity of time. Ashutosh, how many more minutes we have? We can have 10 more minutes or we need to close exactly at 1. Hello, Ashutosh?
Yes, sir. We can take some few minutes, sir. We can go till 150. No problem, sir.
Okay, fine. Can you go back to the presentation? Yeah, next slide. I will skip this slide. We don't have much time for this slide. Next. We can circulate this. Next. Yeah. Key drivers. If you don't understand the key drivers of the industry or of a particular sector, you will never be able to do any meaningful analysis. Let me give you an example of the engineering industry in India just to act as a case in point so that it lends perspective to what should be the key drivers. Normally हम किसी को भी बोलते हैं कि what are the key drivers of the industry, people will say okay, GDP is growing, per capita income is growing, so people will have so much more money to spend. Since so much more money to spend, the marginal propensity to buy something increases up, premiumization is happening. There are a lot of couples in the country who don't have kids, both of them are earning, the ability to spend more is increasing, therefore this will help. These are generic drivers. What are the key drivers? Look at the engineering industry. Let me give you a statistic from the engineering industry. 80%, 80%, I'm not saying less number, 75 to 80% of the engineering industry's revenue in the country come from the power sector. Yeah, because power is an industry which any country cannot outsource. Each country produces its own power. It is an industry which cannot be outsourced. First of all, from the strategic point of view and also from the logistics point of view. And power industry is one industry which requires significant engineering inputs. So the growth of the engineering industry, Ashutosh, we lost the presentation. Can you just put on the slide? The growth of the engineering industry is primarily predicated on the growth of the power sector in large part. So if the power sector in the country is going through some turmoil or some changes, unlikely that the engineering sector will do exceedingly well. So if you have not understood engineering sector with its linkage of its predominant linkage to the power sector, you have missed something in your analysis. Just to give you an example. Aditya, can we see the presentation? Presentation is off. Hello? 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 Yeah. Next slide. Did you guys miss anything or was I audible? So we have already discussed this slide. Let's go to next slide. Next slide. Ashutosh, next slide. Yeah. There are various frameworks which are available to understand and analyze industry. The traditional framework is what we call the SWOT analysis. SWOT is strength, weakness, opportunities, and threats. And there are a few established frameworks. First is Michael Porter's 5 force analysis. What are the five forces of Marcus Porter's? Let me list them down for the benefit of all in the chat box. Porter's five forces. First force is bargaining power of customers. Yeah. Second is bargaining power of suppliers. Third is competitive intensity. Fourth is barriers to entry. And fifth is threat of substitutes. Yeah. Can we go back to the presentation? So let me not dwell into each of them and let me present you a Porter's analysis of one industry to act as a prototype before we close the session for the day. Can we go to the next slide, Ashutosh? Not this slide, next. Yeah. So what I have done is I have tried to assess the internet as a value creator or a value destroyer. So let's say somebody sets up another .com or an e-commerce business in the country. Another e-commerce business. Let's say I come up with an exclusive company which retails office stationery, and I say stationery.com or something and an e-commerce firm. So I'm using the internet as a primary method in which I am trying to trade. So what is the power of supplier? Primarily, I am going to use the web software and the owners of the main portal, which means I am going to advertise myself on Google Ads, or I am going to use Microsoft machinery, or I am going to use Unix code. So my suppliers are all large technological giants who will have a much higher bargaining power as compared to me, which means that I will have no choice on whether to pay them or at what rate to pay them. I will have to pay them as they demand. So my bargaining power of suppliers from my perspective is very low. Bargaining power of my customers is also very high. Customers have a very high bargaining power. Why? Because I am giving something online. He also can get it offline. He also can get it from my competition. The switching cost for the customer is extremely low. So we have a situation where my bargaining power of my suppliers is very high. Bargaining power of my customers is also high. Barriers to entry, barriers to entry are low because all it takes is to set up a web page, an internet portal, and some basic money to set up a portal and set up a supply chain to make a competition. So anybody can enter the business. Barrier to entry is also low. So we have a scenario out of five forces. Bargaining power of supplier is high, bargaining power of customer is high, barrier to entry is low. Yeah. The other thing, substitutes. Substitute is high because if I am not supplying through the e-commerce channel, somebody can always go and use the technical traditional brick and mortar channel and give the supply. So even from a product substitution or a channel substitution perspective, my threat of substitute is also high. So out of five forces, four forces, bargaining power of supplier, bargaining power of buyer, barrier to entry is low, and substitute is high. Industry rivalry. How many players are there competing? Barrier to entry is low, so there may be large number of players. Now, if you put all these things put together, you will now realize that why the marginal propensity of a new e-commerce player in the country or in the world and he being profitable is much lower. The odds are stacked against him, primarily because if I am using the Potter's five forces to analyze that industry, neither does he have a bargaining power nor The supplier has a high bargaining power, the customer has a high bargaining power, substitution is easy, barrier to entry is low, and industry rivalry is fierce. What does it result into? Very low margins. Survivorship is a issue. One of the reasons why you see a large number of failures in the dot com or the e-commerce space. Yeah. So let's go to the next slide, Ashutosh. When we analyze competitive intensity, we just have two more slides before we will close the session for the day. When we analyze the competitive industry of the session, we have to understand what is a commodity play, what is a manufacturing play, and whether it is services. When we say commodities, we've already understood what is commodities correctly. Commodities are commodities primarily because the price setting is done internationally. You are a price taker, you are not a price predictor. For example, the price of steel in India is set up internationally. The Indian steel producers follow the steel price. Their pricing is a derivative of the international steel price. Yeah, that is a classic example of commodities. All commodities prices are market driven prices. It is the cost which they manage, not the prices. So in case of commodity, if you have to effectively manage cost because you are competing on cost, you are not competing on sales or you are not competing on pricing. Therefore, the requirement or the tie-up for raw material, the availability and a valued raw material is very important. For example, cement companies, they have tie-up with limestone mines because the primary input for cement is limestone. The primary input for steel industry is iron ore. Tata Steel has back-to-back tie-up for iron ore. But for that tie-up, their business may not be profitable. Their cost may not be managed. So when you analyze the competitive intensity of commodity sectors, the tie-up for raw materials and the ability to continue to procure raw material at effective prices is a very important ingredient to analyzing competitive intensity of commodity plays. For services, switching cost, accuracy and reliability is very important. Switching cost. If you are having an online trading vendor and there is not much transparency with online trading, it is very easy to switch to another online trading person, correct? So switching cost has to be taken in services into consideration. And in manufacturing, value addition, there are a large number of auto component players all over the country. As many as 3 lakh auto component players in the country exist as we speak. Meaningful auto component companies, not the extremely small marginal players. Now, some of these auto component vendors are also producing engine components. Some of these players are producing very low value added items. For example, spark plugs. For example, tire accessories. For example, window accessories. These are easily substitutable. These can be easily made by anybody. But the persons who are having a higher value addition, for example, guys who are doing engine components, they are not easily replaceable. So when you do competitive intensity for manufacturing companies, at what category of value addition that company is competing on becomes important. When you use services, at what switching cost that customer has becomes important. When you do commodities, the availability and the tie-up for raw materials becomes important. So these things need to be taken care of. Can we go to the next slide, Ashutosh? So as a rule of thumb, business insight across industries, cumulative years of experience in the industry, I'm putting it on a slide 30. Any industry where the products are recurring, they perform better as compared to recurring services. Any industry where there are recurring services, they would perform better than one-time products. Recurring products, example, fast-moving consumer goods, Fevicol, adhesives, monopolistic products, stationery items. Recurring services, online trading, banking, one-time products, capital goods, one-time services, movers and packers, logistic services, moving services, plant erection and assembly services. Yeah, giving you examples of each of them. So with these guys, I think we'll end the session. I would not like to encroach on much time. Thank you. Thank you very much. Ashish, you can share the presentations with the participants. May I log off?
Sure, sir. Yeah, please, sir.
You can
We'll
end,
share the presentation to
you can
everyone.
end the meeting, Ashutosh.
Yeah, yeah. Thank you. Thank you so much. We'll meet again at the same time tomorrow. Please be there. Sir will be there with us. Thank you.
Thank you.
Yeah. Team IT, please close the session and stop the recording.